Welcome to the video. First, we will set the stage. Earning a high income does not automatically equal financial security if high-interest consumer debt is draining your cash flow. In this episode, I will show you a practical, urgent framework to stop the bleeding and regain control. We will cover why high-interest debt cancels out typical investment returns, the triage choices you need to make now, and an aggressive but doable plan to eliminate six-figure debt in under 2 years. Let's get started. Here is the roadmap. First, we will explore the mechanics of the high-income, high-debt trap. Next, we will walk through the controversial triage decisions that prioritize debt elimination. Then, we will learn how to run a granular budget audit to find spending leakage. After that, we will detail the debt avalanche strategy. We will also visualize a 24-month payoff timeline. Finally, we will conclude with key takeaways and quick quizzes to test your understanding before wrapping up. Before we proceed, here is a quick disclaimer. This content is educational and general in nature. It is not financial, legal, or tax advice. Individual circumstances vary widely, and you should consult a qualified professional to tailor any strategy to your specific situation. With that clear, let's move forward to understand the trap and how to get out of it. Let's begin with the core paradox. You can earn $9,000 per month and still feel broke if you are servicing around $100,000 of consumer debt at double-digit interest rates. The math is unforgiving. Paying 16% to lenders while hoping to earn around 7% in long-term retirement investments means your gains are more than erased by interest charges. Add lifestyle creep and multiple minimum payments, and your cash flow is soaked up before progress can happen. Therefore, the immediate conclusion is to pause conventional saving beyond very specific exceptions and redirect the maximum possible cash toward high-interest balances. Now, let's visualize why interest wins. When your debt costs 15 to 16% annually, even respectable investment returns of around 7% are not competitive. Each month you postpone an aggressive payoff, compounding interest quietly inflates your balances. Therefore, the most financially rational move is to attack the highest annual percentage rate first to minimize total interest paid over time. Here is the triage. First, contribute to your employer-sponsored retirement plan only up to the full employer match. The match is free compensation you should not forfeit, but every dollar above the match should be redirected to debt. Second, establish a lean emergency buffer of $6,000 to $8,000, roughly 1 to 2 months of total expenses, and pause further savings until high-interest balances are significantly reduced. Third, liquidate non-essential and volatile assets, such as speculative crypto holdings or idle cash spread across multiple accounts, and immediately apply the proceeds to principal. These moves are controversial because they temporarily deprioritize conventional savings behaviors, but the arithmetic of high interest makes them the most rational choices. Next, conduct a granular budget audit. Start by exporting 3 to 6 months of transactions from every bank and card. Categorize each line item and split shared purchases accurately. Then, total each category and compare it to a realistic target budget. Identify leakage in areas such as dining out, subscriptions, delivery services, rideshare usage, and impulse purchases. Establish caps and rules by using techniques like cash envelopes, debit-only days, and a subscription audit to cancel unused services. Automate your cash flow by splitting each paycheck into bills, debt, and essentials first. Finally, conduct a brief weekly review to correct any drift and maintain momentum. This table shows common leakage categories uncovered during audits. Compare the planned budget to the actual spend, compute the negative delta, and then implement a specific fix. For instance, reduce dining out by capping to $300. And increase meal preparation frequency. Cancel unused subscriptions or switch to annual billing to obtain discounts. Replace rideshare trips with public transit a couple times a week, and batch errands. Avoid delivery fees by picking up or batch cooking. Apply a 48-hour rule to impulse purchases and remove stored cards from e-commerce sites. For miscellaneous small leaks, use a weekly cash envelope with a hard cap. This timeline illustrates an aggressive 24-month payoff plan. The first 1 to 2 months focus on building a lean $6,000 to $8,000 emergency buffer and pausing all other savings. Starting in month 1, all surplus above the employer retirement match is redirected to the highest interest loan. Months 3 to 10, focus on eliminating Loan A at approximately 15.99%. Months 11 to 18, Redirect the newly freed payment to Loan B at roughly 13.49%. Months 19 to 24, finish Loan C at about 10.25%, after which you rebuild a fuller emergency fund. Liquidation of non-essential assets happens at the beginning, and brief weekly budget audits continue throughout. Here is how the debt avalanche method works. You continue paying the minimum on every loan to stay current. Then you direct every extra dollar to the highest annual percentage rate loan. Once that loan is eliminated, you roll the entire freed payment amount into the next highest rate loan. This method saves the most interest and provides the fastest mathematical route to becoming debt-free. This comparison contrasts two debt payoff methods. The avalanche orders debts by highest interest rate to lowest, which minimizes total interest paid and is mathematically optimal, though it may offer fewer early psychological wins. The snowball orders debts by smallest balance to largest, generating early victories that can boost motivation, but it often results in paying more total interest. Choose the method that you will stick with. Although in a high-interest environment, avalanche typically yields superior financial results. Quiz time. The question is, in high-interest debt triage, what is the recommended approach to 401k contributions? The options are: 1. Continue maxing to the IRS limit. 2. Contribute only up to the employer match. 3. Stop all contributions including the match. Or 4. Move contributions into crypto instead. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to contribute only up to the employer match. The match is effectively free compensation. Above that, redirect all available funds to eliminate high-interest balances as quickly as possible. Here is the second quiz. The question is, which method typically saves the most interest over time? The options are debt avalanche, debt snowball, randomly pick a loan each month, or pay only minimums on all loans. You may pause the video now to think about the answer. We will reveal the answer in the following section. The correct answer is the debt avalanche. By focusing first on the highest interest rate, you reduce the cumulative interest charges and reach debt freedom faster in mathematical terms. Here is a simple one-week action plan. On day 1, export your transactions and document every debt with balances, annual percentage rates, and minimum payments. On day 2, build a lean budget with caps for each category. On day 3, adjust your retirement contribution settings to match only and redirect the difference to debt. On day 4, finalize your lean emergency buffer between $6,000 and $8,000 and pause additional savings. On day 5, liquidate non-essential, volatile assets and submit the proceeds as principal payments immediately. On day 6, automate paycheck splits into bills, debt, and essentials, and align bill due dates when possible. On day 7, conduct your first weekly audit and adjust category caps based on what you learn. These are the essential points. High income can conceal significant spending leakage. Interest rates above 10% overpower most investment returns, so they must be attacked first. Keep retirement contributions to the employer match. Maintain only a lean emergency buffer during the payoff period, and liquidate non-essential assets. Use the avalanche method to save the most interest, and reinforce your system with weekly audits and automation. To summarize, recognize the high-income, high-debt trap and pause conventional saving beyond the employer match. Reallocate as much cash as possible by cutting spending leakage and automating your financial flows. Apply the avalanche strategy to aggressively pay down balances, making it possible to eliminate $100,000 of high-interest debt in under 2 years. Short-term sacrifice produces long-term freedom. Thanks for watching. If you found this helpful, please like the video, share it with someone who needs it, and subscribe for more practical money guidance. Tell us in the comments what your biggest budget leak has been and what change you will make this week.